Let's pick up on our conversation with Jay Taylor, President and CEO of Taylor Hard Money Advisors, and joining us in Singapore. We've been talking a lot about the price of gold. We know margins are being restored and thereby profits as well. Would you bet some gold bars on the fact that there will be some more consolidation in the gold sector?
Oh, absolutely. I think we've had a nice run here, although I do think that having broken through 1,000, when you look at the charts, to me, I see 1,300 or 1,325 or so as sort of my near-term objective. And but yes, I think a pullback is certainly to be expected somewhere along the way. I would welcome it.
Are we talking mega mergers in the sector, Jay? In terms of the big ones, we're here, Newmont could be fishing around, potentially looking at Newcrest in Australia, or do you think it'll be more the big players taking over the smaller ones?
Yeah, I think the big players taking over the smaller ones is likely to happen. Personally, I cover the junior mining sector primarily in Canada. And what we're seeing, the junior companies are really the ones that are good at finding gold. They're the ones that have the flexibility to go out and test geological theories and put the drill bit down and spend speculative money to find these things, whereas the major companies are so concerned about next quarter's earnings. And so what we're seeing, the majors are not replacing their gold production from their own exploration development. So there are a lot of different junior mining companies, I think, in Canada that I keep my eye on that I think are going to be targets. Companies that are coming up with multi-million ounce deposits that are really worth the while for major companies.
Jay, the fact that a lot of the big miners have closed their forward hedge books, making them more exposed to the spot price, that's clearly been a strategy that's paid off for them, hasn't it?
Well, it certainly has, but of course Barrick being the most, the prime example in North America at least of companies that was hedged. It cost them an awful lot of money. I think they might have made $2 billion during, when gold was in a bear market, and it cost them $4 billion to unhedge it. So, and they still have some to go. But I think it's a sign that, virtually everybody believes that we're in a long-term bull market for gold. And when you look at what's going on with the U.S. dollar, when you look at what the Obama administration and the Federal Reserve is doing in creating money, endless amounts of money, trillions of dollars, it's to be expected, because
at some point in the cycle the Fed is going to have to normalize rates, and when that happens the dollar invariably is going to rebound. So isn't that going to derail the rally in gold at some point?
It could, but I'm not sure when they're going to be able to do that. Looking at the economy as I see it in the U.S., and as I talked about it a few minutes ago, it really looks very bearish, and I think it would be a very, very difficult thing politically for the Fed to start doing that now. I don't expect it anytime soon.
So that being said, Jay, should investors be putting their money into shares of companies that mine gold and other metals?
Yes, I definitely believe so long term. You want to be cautious. In the junior sector, there's a lot of speculation. I tell my subscribers not to allocate more than 5% of their portfolios to any one stock. But I think the mining shares, again, if we have a deflationary event, if we have another credit implosion like we had last fall, and I know that's not a popular view right now, but it's one that I hold as a distinct possibility. If we get that, then I think the mining shares are going to be very, very attractive, more than they are now. Actually, what I've been telling my subscribers is to build some cash for that event. So we've raised about 25 or 30% of our portfolio.
More attractive than the ETFs?
Yeah, I'm not particularly keen on the ETFs. I mean, that's an easy way to trade gold. I don't like to own it that way.
What are you basing your implosion scenario on, very quickly?
Well, if I look at charts and looking at some Elliott wave analyses and just the economy that I'm talking about, I'm not convinced that China, the demand in China, can replace the American consumer, which was the engine of the world's growth. If China can do that, then maybe maybe we don't get the same kind of implosion, but in the equity markets and in the economy. But what I see in the U.S., it's not very promising.
Okay, thank you so much for your time today, Jay. Good to have you on the show. That was Jay Taylor, the President and CEO of Taylor Hard Money Advisors.